Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts, and it's risk-taking and risk-takers is the conversation this week.
Yes, it is.
Are you one? And if you are one, you're taking some right now. That's right. At the time we're taping this podcast, Phil, we got the numbers Friday. We're taping this on Tuesday, so we've had business days of last Friday, Monday, and Tuesday.
Yeah,
and it ain't been pretty.
It's been a little rough.
Yeah.
Yeah, you're testing your risk tolerance, that's for sure. So
we figured this might be a good time to have that conversation along with
Sure.
the fact of what we're seeing. The inflation numbers came out, 8.6. It peaked in March, April. I don't know.
They saw a little drop in April, and they were hoping, this is the turn.
I don't know if anybody really bought that or not.
No,
it didn't drop. Pretty high, and immediately we've been pummeled a little bit since then. So we're down about 16% on the Dow, I think, total for the year.
Down 16. The S&P broke the barrier, so to speak. So It's, I think, 21, a little over 21. Excuse me. And the Nasdaq's almost 31. So
yeah, that one's been taking a beating.
Nasdaq's been hit pretty hard early on, but it's.
Well, when these things happen, and hopefully maybe a lot of folks did this prior to, because we've talked about it a number of times for a while now, but basically, let's see if your risk tolerance matches what you're dealing with, because again, we wind up being okay with the risk over the last couple of years, but obviously, you and I've been preaching this for 6-8 months now, saying, hey, pay attention to this because we're in for some choppy waters. And can you handle the downside? Everybody loves the upside. So
right. Yeah. And that's always the challenge. I mean, we've had a good run for a while here. People get comfortable.
Oh yeah.
And then reality starts to set in again. So,
well, at the time we're taping this, like I said, it's Tuesday. What is today? What's the date? I'm not even sure what today is.
It is the 14th, Flag Day.
Flag Day. Okay, thank you. So it looks like the Dow tumbles 876 points to enter bear market. That's from CNN. I don't know if the Dow's actually in bear yet, but that's what they're saying. Looks like an 84-point climb to start the day, thanks to Chevron and Goldman Sachs. I mean, again, we're going to have this up and down, but basically we've seen a pretty good fall in just the last 3 days. Due to the inflation numbers, 50% on gas. I don't think that you see that number and it still hurts, even though I don't think we're totally surprised.
Right.
But I mean, a 50% increase on gas was those numbers that came out. 8.6 on regular inflation. I think groceries were 15% on average.
Yeah.
That's tough. I mean, it's hard, and people are, we're seeing more, stories of people trying to figure out, what to do. It's a balance of putting gas in the car and buying groceries,
food at the table, and rent, and all the other,
And then you add into that, the thoughts of retirement start to go out the window for many people. Well, I can't think about that right now, right? I got these other things to deal with. Even if you're 10 or 15 years away, you're definitely putting it on the back burner. People, this is what we tend to do. We tend to say, well, 15 years away, I can't think about retirement. I'll have to deal with that later, right?
Yeah.
You're 5-7 years away, you're paying a lot more attention to some of this movement. So let's talk about a few of these things. If we're out of whack, if we're out of balance, maybe what we can do about it a little bit. What percentage do you think, I'm not going to say your clients, because your clients already have a plan, they already have a strategy.
Right.
What percentage of just general people that are not working with a professional do you think are comfortable with the risk they have? Or do they even know?
Well, I think that's the real point there. They don't know. Most of the prospective clients, let's put it that way, that I meet with as they come in at a class, one of our classes, looking at their portfolios and allocations, having that risk discussion, a lot of them are just in 401k still, so it's very common that I'll see, well, I really haven't looked at that allocation in, maybe 10 or 15 years, and it's just one of those things, you set the allocation and, it's been doing good. Why would I touch it? Let's ride through it. It's, I've been happy with the performance, and
let it rip.
let it rip. Yeah. And that's great as long as you got time. But it's, and I've been having this discussion with clients and prospective clients for years now of saying, look, you got to understand this whole concept of average returns and how it plays out. And, what they call reversion to the mean. I mean, anytime you get a way above an average return, I mean, at some point the market has to give to come back to that average,
Right.
bounce way below the average to start to bring that average return back down, and I mean, it's just nature, if you want to call it. I mean, it's what markets do.
Yeah.
They don't always go up.
No, for sure. But we got, again, we get kind of lulled into that the last couple of years. Now, I saw something that that technically where the Dow is right about where it was of October of 21. Mm-hmm. So, in a way, it's like we're panicking because we saw it go up to 36,000, almost 37,000 was the 52-week high.
Right.
And then, we're down at a new low at 30,373 when the day started. It's starting to dip a little went up a little bit. Now it's starting to drop again. Yeah. But anyway, so, it's not like you see these headlines like bloodbath. I saw one yesterday, bloodbath, no. Right? I don't know that it's quite that bad, but people are certainly panicked when you add all the other inflationary issues we're dealing with, right?
Yeah, I mean, you always, when you're in the middle of it, the experience over the first couple of days as markets go through some of this, it's terrible, right. But the reality is, I mean, if you were to look at a chart of the Dow or the S&P and back that out and look at a 10, 12, 15-year timeline, gives you perspective, right? Yeah, I mean it's
even
bad.
18 months, it's not
coming
that
down,
bad. Yeah.
Right? But but the flip side of that coin, though, I think, is just the reality of, I mean, it feels bad,
yeah,
but it's not really that bad in perspective. But how bad could it get?
That's the thing, right?
This unfortunately could just be the beginning of
right.
Entering that bear market, right. And that's what markets do. I mean, if you look back, 2008 was no different. 2000, I mean, they all, anytime you go through these bear market cycles, it does the same thing. There's these downtrends, and then, people get hope and things happen. And, like this, the inflation, oh yeah, the number wasn't as bad as we thought. And I think it's going to be better. And hope right. starts to build in the market. And then bad news hits and boom, the rug gets pulled out again and it drops again.
Yeah.
I mean, that's pretty typical as you go through these cycles. It's not just a straight down,
right.
Even though when you look at it, from a high level, it looks like that. But I mean, it's just down and up a little bit and down. And, so.
Yeah, it's just a little more downs, a little more ups.
Overall,
ups, right.
Overall, there's way more downs than ups for sure. But I mean, it's not, it's, yeah. So we very well could see an uptrend over the next 2-3 days, week.
Right. Yeah.
Is this the end of it? I don't know. I find it hard to believe it is.
Yeah. Especially with continuing stuff going to keep coming. All right. So if we're talking about this from the angle of risk, then, okay. So, the average person walks in and they say, hey, I thought, I opened up my, I decided to look at my 401k, which I've been scared to do. Yep. I didn't take as much, I haven't lost as much as I thought I was going to.
Right.
So I guess I was right. I'm not that much at risk. How can they know? Like, how can we figure out? Because, like, okay, somebody comes in and says, Phil, I don't want to take any risk. And then you go dissecting their portfolio. How often does it even match? Most advisors I talk to say it's virtually never matching.
Never matches. Yeah. I mean, there's never an exact match for sure.
Or even close a lot of times. I don't want to take any risk. And then you look and it's like,
oh, yeah. I mean, especially if somebody says, I don't want to take any risk. I think my portfolio is good. I'm not taking any risk. I've got all dividend paying stocks. I'm not taking much risk, but the reality is, there's a lot of risk in dividend paying stocks. I mean, any stock has risk. I mean, bonds, the asset class that most people thought was the safe asset class. I mean, they're down over 10% this year. I mean, it's, it's been the worst bond market, I think, on record.
Yeah.
So, I mean, it's, you've got to understand risk and anytime you're invested in anything, stocks, bonds, anything market-based, there's risk. There's no such thing as no risk in anything market-based. You're going to have volatility.
Right.
It's a measure of how much risk and
how much you can handle, how much you can take, the time you're in. So how do we figure it out? I guess that's the question. Like, if we're doing it on our own, is there a way to figure it out? Or do we truly need to sit down with a professional who can kind of go through? It's almost like the sleep number thing, right?
Right.
Like, give me a number, Phil. Like, give me a On a scale of 0 to 100, and
Mhm.
100 being, is that high? Is it the 100?
Yeah,
Is
I mean,
that
100's
bad?
the high, and yeah,
Okay. Yeah. So on a scale of 1 to 100, I want to be at 30. Where am I at? Like, how do we figure that out?
right. Well, and I mean, the funny thing to me with risk has been, well, what does that mean, right?
Yeah.
Because another way of looking at it is, well, I'm a moderate investor, or I'm a moderate
Right. Which
conservative.
is so
Well,
vague.
what
Yeah.
does that mean? Even that, a scale of 1 to 100 and a 30. So what is a 30? You know,
Mhm.
personally, I like to look at it more of what is your comfort level? What's that maximum drawdown? And I ask clients all the
Okay.
time, so if you open up your portfolio and you're watching it and we're down 10%, what is that number? You say, uncle, get me out. I just can't do it.
Okay. So we said the
So
Dow was down 13 to as of the
right,
time we're taping this. So if 13 was your uncle point.
right.
Okay.
Then over what period of time? Is that over 6 months, or is that just period from a high to a low?
Okay.
Or,
Okay.
what's your parameters? Because you want to have that discussion up front, because you don't
Yeah.
want to get to that point and then say uncle,
Right.
because,
Yeah.
because now it's, obviously the wrong point to get out.
Yeah.
I mean, if you're at this stage, not saying you shouldn't make a change, but just understand, right? I mean, have a strategy. It all has to come back to a strategy that you need to think this through. Risk is something you need to understand a position before you get in the middle of it.
Well, and that's fair, but
So,
since we are in the middle of it,
right. So since you're in the
then
middle of it, it's still something to understand. Okay, I've taken this amount of a
I was gonna
loss.
say, is it worth it to find out so we don't take a further beating?
It could. Yes. I mean, if, everyone's scenario is different. I mean, if
Sure.
this is money you're needing to live on and you're pulling money, out of this 401k or IRA every month to live on,
While it's dropping,
while it's dropping, it's a big problem.
that's a big problem.
You need to reevaluate, because if we are just in the beginning and have just entered a bear market and we have another, who knows how far to go.
Mm-hmm.
Yeah. Do you really want to see your portfolio go down another 20, 30% or whatever the bottom is? We don't know.
Right.
And you're still pulling money out. That's not a good scenario.
Yeah, you're double dipping, and not in a good way.
Right. And this is one of those, I think we all get tied into a number, right? They call it recency bias.
Yeah.
So we look at our portfolio and it was, oh, this is the number. I mean, I was at X amount and I'm not going to make any change until I get back there.
Mm-hmm.
Well, you might not get back there. I mean, especially if you're pulling money out. So don't get tied to what it was. Look at where it's at today, reevaluate risk. And I mean, if it's not appropriate, absolutely make a change, because and not necessarily with all of it. And this is, again,
I was gonna say, okay, thank you for hitting that. Not necessarily all of it.
Right.
Maybe we need to, do the risk assessment, I guess, for lack of a better term.
Yes.
And then figure out, okay, how much should we move away to more safe, functions, and then
Correct.
how much should we continue to leave there in the event that it is short lived or whatever. Is that where you're kind of?
Oh, absolutely. Well, I mean, personally, how we do it is, and we've talked about this a lot of times on the program, but we bucketize money, right? So we'll have a soon bucket and a later bucket. Most clients, when they're looking at their portfolios, they're looking at the whole thing.
Yeah.
That's pretty typical. I mean, you look at your 401k, it's one account, right? So you're saying my portfolio, this is the allocation, my risk is this, and it's that way on the whole account.
Right.
How we look at it, especially as you enter retirement or get close to it, is we're looking at that money you're going to need in the next 10 to 11 years. That has to have a different risk profile than what your later money does. And we're looking still at the combination of the two overall. So on average, if your comfort level is that moderate investor,
mm-hmm.
well, maybe that means that soon money is going to be conservative. So we don't want to have as much risk there. But now we're going to have the later money a little bit more aggressive. So you're not going to hit any account that's average, that moderate, but you're going to have some that's a lot higher risk, but you've got time. And that's the whole thing with risk is time, right? Well, in having that segregation helps with that, because that, well, the daily money that I need doesn't have as much risk. I can ride through this volatility.
Yeah.
The later money, you can take a little bit more risk, and you need to, because to get those returns that are going to help keep up with inflation over time, you have to have the ability to take a little bit more risk, but you're not going to touch it. And as long as you don't touch it in these kind of markets, historically, markets do what they do. They go through these cycles, they do come back.
So and my next question would be like, how do we get to where we're in this position where we're taking a lot of unnecessary risk? And I'll use an example. I was talking with a 60-something-year-old gentleman the other day, and he said, and like some others, he said, I decided, and this is before the last 3-day issue, but he said, I decided to go ahead and look because we know it's been falling for weeks, right? He said, so I decided to go ahead and take a look, and I hadn't lost as much as I thought. And I said, what are you in? And he said, oh, I'm just in a target date fund. Right. And so he was surprised because he did know, and he's like, I do know that they're not, they're supposed to pare back risk, but they don't pare back as much as we think they do.
Yeah.
So he was kind of surprised that he was not losing as much. So maybe the target date fund he is in, the allocation, maybe it was not like tech or some things that have been taking a bit more of a beating. Does that make any sense there?
Yeah, I mean, target date funds are real generic. I mean, it's just a blend of more moderate equities and bond, right? I mean, it's meant to be a set it and forget it concept. But
right,
I mean, at the end of the day, it's not, to your point, as conservative as most people think for sure.
As they lead us to believe, yeah.
Right, because I mean, the reality in looking at target date funds, and everyone's a little bit different, but that, if you picked like a 2025 fund, pretty close to retirement right now.
He is in actually.
You're actually about a 60-40, 60% stock, 40% bond allocation.
Yeah.
Which I think a lot of people, when they look
at it's the other way.
This is a 25, I'm retiring in 2025. That's like in 2 years or 3 years.
Shouldn't it be 40,
it should
60?
be really, conservative. And they look at it like, what?
Yeah.
So
that's where he was. Like, I think he thought it would be like more 40, in the market and 60 safe, and it was the other way around. But yet he was still surprised he hadn't taken the bloodbath that he thought he was.
Right. Yeah. So I mean, the bottom line, don't ignore it. Don't not look at your account. Right. I mean, that's the worst thing you can do. But don't watch it every day either, because I mean, that's going to drive you crazy. Understand what's there. And the end of the day, you got to have a plan. Risk, like anything, you need to understand it, manage it. None of us can control it. It's going to be what it's going to be. I mean, there's tactical management, and we use a lot of that, but at the end of the day, you're still not able to fully control it. It's managing some of the swings.
Yeah.
But risk needs to be positioned properly is the key. At least the way we look at it. I mean, you can't take the same risk in retirement that you took prior with all of the money.
Right, for sure.
But you can't.
But we've been doing
conservative either.
We've been doing that the last couple of years because the market has been so good, right?
Yes, and that's been the challenge. I mean, I'm working with a client right now that we've gone through all the financial planning, and I mean, early on in our process, we'll do the planning first. Then we talk about investments and how that plan can fit in their investment portfolios.
Right.
And we've had this discussion early on, and he was extremely heavy in high growth stock.
Okay.
And has been loving it. It's been a great ride.
Sure.
But I mean, we've had this planning discussion and, started wrapping that up and now getting into the investment discussion.
Yeah.
I mean, he's down significantly, at this stage, 25, 30%.
Right. Not quite as happy as he was before.
No, absolutely. But now he's like, oh, I don't know, but I wasn't going to touch the money for, a few years anyways. And so you get yourself into this paralyzed position. So now you start to, justify but I know I'm not going to touch it. But, my point is, well, okay, that's great. You're down this far, but what's the bottom on this? We don't know.
Yeah. And again, what is your tolerance for where is your line, right?
Right. And it's not even where's your line's a point, right? Because you don't want to get down to the bottom 50% down and then jump out and say, okay, I'm done.
Yeah.
Because now you've locked in that loss.
True.
Especially with all the money. But yet the flip side of that is, especially if you're spending the money, I mean, just think of it kind of an easy concept. If you've lost 50% of value, now you still need the same amount of money every month.
Right.
Well, now you're selling twice as many shares at that point to generate that revenue. So you're it's like doubling your income, right?
Mm-hmm.
From the effect on the account, you're driving that account down even further.
Yeah. Yeah. Well,
so I mean, it's risk is a huge danger in retirement if you don't manage it and understand it. And there's two sides of it. It's the tolerance. How much can you tolerate?
Mm-hmm.
And that's key.
Sure.
you gotta understand that.
Well,
But
'cause
the
that's when
other
we
side of
panic.
it
The
is,
tolerance is what makes us panic and do the wrong thing often. So that's one.
yes, yeah,
Okay.
you don't want to do that. I mean, that's going to completely destroy your plan if you react, do a reaction to something that's happening. I mean, the other side of it is the need for risk, because like it or not, and not everyone. I mean, if you've got $10 million and you're only
Yeah, sure.
spending
Right.
50 a year, well, you could put it in the bank, you bury in the
I
backyard
was
and
gonna
go
say,
pull the
yeah, you
money
could
out.
put
You're
it
going to
in
be
in
okay.
the freezer and you'd be fine. Yeah.
But I mean,
Just don't sell the freezer.
if you're the yeah, sorry, just don't forget it's there. If you're the average investor, I mean, that's not your scenario. You actually need the money and you need it to grow over time.
Yeah, and that's most of us. Yeah.
So yeah, when you look at that scenario, you have to take some risk with some of the money. And that's where you have to understand positioning a risk and what money do you take risk with, what money don't you. So
Well, and that'll bring me to my final point, and then we'll wrap it up. And again, we've talked about this number of times, but we tend to think of, well, there's the market and
mhm,
there's cash, right? There's
right,
there's going to the bank or whatever. And so when we start to see these times, people want to jump out. That's the panic part. They want to
right.
jump out. They just want to go to cash, and they'll sit there for a while. So, is there a way to significantly reduce like some of the risk, to pull back
Mhm.
some of the risk, without also reducing some of those opportunities to maintain some growth? Because obviously, we typically say, well, we got to at least keep up with inflation, and right now that feels like a crazy foreign concept because we know we can't, because it's so high, but normal
Yeah.
inflation. So what do we do in this kind of time period where, okay, maybe we do pare something off the table, but also how do we kind of, like, it's not just the market and just cash. There's got to be something else we can look at, right?
Oh, absolutely. Yeah. So there's a lot of other types of investments. Annuities is one of them,
Right.
and we've talked a little bit about that, the annuity word, right?
And
Everyone, oh yeah,
this is
you
the
can't talk
time
about
when people who are
annuities.
not fans of that, they start to pay attention because they're like, well, this might,
Absolutely.
yeah,
Right. So I mean, there's types of annuities that are called a fixed indexed annuity that will participate in a market upside, but not
right,
all of it.
right,
You're never going to get all the upside, but what it does is it protects you from the downside.
right,
So those are kind of a moderate to conservative investment, strategy, or even more on the conservative, because you're never going to lose.
right.
There are going to be years you're not going to earn anything, so if the market's down over that year, you're not going to get any interest, but at least you're not going to lose the principal.
But for a portion, that could
But
be an option.
absolutely. And this, with any of this, is always a portion,
Yeah.
and that's why, again, it comes back to having a retirement plan, an income plan, right? Cash flow, understanding money in, money out. What do I need? How much am I going to be pulling from the accounts over time? Yeah. Once you have that, then you have to have an investment plan that matches it.
Yeah. I need a little bit over here.
Yep.
Big shock. We've been talking about that. I need a little bit over here. And again, even if like an annuity is not something you've been a fan of, and I'm not just saying that, but just because Phil brought it up, but there's other things to look at.
There's other options.
You may have to open your mind up in times like these to say, okay, it's not just the market and it's not just cash, because I'm still not getting a whole heck of a lot for cash. Although I did see one bank
it's starting to
1%. Yeah.
Right. It's starting to peak up a little bit. But I mean, it's a funny thing, right? And you look back, people said, "Oh yeah, but back in the '80s, it was. I mean, I could get 8% of the
tired
bank."
Of that, right? Yeah.
Well, yeah, that's great. But what was inflation?
Right.
Your mortgage
your
was like
mortgage
15, and
right,
I mean, come on, it's perspective, right?
Yeah.
There's no time in history that money in the bank's going to keep up with inflation. It just doesn't exist. That's not the purpose.
But we've been dealing with 1%, Phil. I'll take 4. It makes me feel better, right?
It makes you feel better, but it's perspective. Yeah. So I mean, cash is. You have to have it. That's, our now bucket, right? That's money really we don't ever plan on spending. That's the emergency fund type money.
Right.
You need that money there, or money you're going to spend in the next year, let's say, right? I mean, that's where cash fits in, or a lot of our managers, we use a lot of tactical managers, they'll go to cash as a hedge, right? As markets are moving, they'll go into a cash position for a short period of time. It's not because it's earning anything. It's more of a risk off positioning.
Mm-hmm. Okay.
So yeah, to me, I would encourage you, when you're looking at risk, never look at the whole thing. You've got to understand risk overall.
Right. Right.
Don't look at your whole portfolio as one. What is your overall comfort level? And then segregate the monies to be able to handle risk and position it in the right scenario, right? For longer term, you can take a little bit more risk. It's going to have a little more volatility, but you need that to grow long term.
Right.
And everyone's scenario is different. You can't just make, this is what you should do.
Yeah. Well, and we've talked about that about a
Yeah.
million times, right? So it's like we've been saying for a while now, and not to say that we're being prognosticators by any
Yep.
means, but it's just like the writing's been on the wall. I think we all can acknowledge that things were going to continue to stay. We've been choppy basically since 22 opened,
Right.
since the year started. So all these things that we've been watching have added to it. And so if you've been taking risk or unnecessary risk the last couple of years, because to Phil's
Right.
point, you've been doing well. Now you're maybe regretting that decision by not at least getting that update or that reevaluation or that assessment. A lot of times if you're
Right.
not working with a professional or you're not working with an advisor, you don't have those checkups.
Right. The sounding board.
The sounding
Yeah.
board. And
Yep.
and say, hey, this is, looks like we're getting ready to be in for a rocky year this year. How we looking? Do we need
Right.
some tweaks? Doesn't mean it's wholesale changes, but tweaks certainly on the radar.
Right. Yep.
Okay. So are you taking risk? Probably.
Yeah, you better be.
Are you regretting it today?
The long term. Yeah.
Possibly.
Yeah.
So do yourself a favor. Get in and talk with an advisor. Get back. Whatever the case is.
Number one, don't make a harsh decision. Don't just go in and say, I'm done, get me out, without having a plan and understanding the whole picture.
Don't. Yeah, please don't wholesale panic.
Yeah.
Even if you have to do the cliched stuff of remember it is a paper loss until you sell it.
Right.
So you technically haven't lost anything until you cash out, right?
But that being said too, don't put your head in the sand and, I'm going to take it out when this is all over, because especially if you're in retirement and spending the money,
yeah,
it might be not too late, but you might have to dramatically change retirement at that stage if you do it.
Yeah.
So put the brakes on, take a breath, either yourself, if you're doing it,
yeah,
think this through, or if you need help, reach out to that professional, because they can help you walk through what your risk tolerance is, what your income needs are, how you should maybe at this stage reposition things so that going forward, if this is the beginning of a bear market and we continue to fall, you're not going to end up in a worse position than you are today.
Yep.
So
yeah, it's times like these when a lot of the DIYers do turn to the pros and say, okay, maybe I need some help now, or whatever the case is, or folks that are already working with professionals just say, hey, just let's double check. Just
reassure me here, walk me through.
Make sure we're still grooving. Right. Yeah. All that kind of stuff. So we're all on the same boat. Technically,
Right.
I mean, right. It's just a matter of where we're positioned in that boat. So we're going to get out of here, but do yourself a favor. If you're feeling, nervous, and obviously a lot of people are, and it's understandable, check that risk tolerance with your professional or get a professional. Reach out to Phil if you need to talk with somebody. You can find him online at philstaxhacks.com. That's philstaxhacks.com, or you can call him at 248-888-7530. Did I remember that right without doing it?
You did.
248-888-7530. There you go. So give him a call, give a professional call at somebody, but definitely talk with a pro. And we'll see you next time here on Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.